All right. So now we dealt with the first half of chapter 7, right? All we dealt with right there was our purchases. Now we're going to go ahead and introduce you to the perpetual inventory sales. Now notice this. When we did chapter 5, right? Chapter 5 was dealing with just the purchases of inventory, and that was it. Chapter 6 is where we got to introduce what happens to periodic sales. In this case, for perpetual inventory, right, we understand that every purchase that we make, we have to update our inventory. Every sale we make, we have to update our inventory. So in this case, it's going to be a little flip backwards, but it makes sense to teach you both the purchase first and the sales first. And then chapter 8 will be dealing with how to actually cost out the methods, okay? Because these two components is what makes up your costing method for perpetual inventory, okay? So once again, we're going to go ahead and take a look at perpetual inventory sales. So of course, we talked about this before. The nature of a business, right? The whole purpose of being in business is to make a profit. And how do we determine our profit? Is because we are merchandising inventory. Our main core business activity is to sell out our merchandise. So in order to do that, we need to recognize our sales. And what is the selling price consisting of? 1, all the cost it takes to get the asset to your store, plus some kind of profit percentage, right? Some kind of profit margin that you want to earn on every single item that you sell, okay? And of course, with that, if you are in that state that charges sales tax, well, you have to consider it, all right? And one thing is that I believe only 5 states don't charge sales tax, okay? So we are in one of the states that does charge sales tax, and for this class, because it's a little more complicated, I only strictly want you to know 8.25%, right? Sales tax is going to be determined based on the state that you are running your business in and on top of the local agency. So your sales tax can vary from any type of percentage. But for this class, I want to keep it sweet and simple. 8.25 is our sales tax, okay? So once again, how do we determine sales, okay? So in this case, example here, on June 1st, we have 10 toys, and you sold them for $9.99 each, okay? Sales tax is 8.25%, and the toys were originally purchased for $5.85, okay? So how are we going to record this transaction? So first, let's focus on the first portion here, right? We need to just recognize our sales, okay? And then we have another key component here. So this is the difference between periodic and perpetual sales, right? Periodic, we recognize just the sales and just the sales only. When we move into perpetual inventory, we need to recognize the cost of goods sold, right? Familiar account that we've seen before, right? But this time, it's going to be done at time of a sale, okay? And this is how we keep track of our inventory. So let's go ahead and journalize the first section. So if I sold 10 toys at $9.99, what is my first journal section of the journal going to reflect as?
Cash accounts, cash or accounts receivable.
Uh-huh.
And then you would have to credit your sales and sales tax.
Correct. That's the first section right here. We're just going to recognize what happened here. In this case, I made a sale. I made a sale for 10 toys at $9.99, which, how much is my sales?
$99.90.
How much is my tax on top of that?
$8.24.
Good. Bringing you a grand total of $108.14. Now, here's the second portion of the sales that every time we journalize, because we're dealing with perpetual inventory, right? We need to keep track of every item that we sold. So in this case, if I sold 10 items, right? And it originally cost me $5.85 to purchase it, right, from my vendor. How much is it going to be written off of my inventory?
Did you do the 10 toys you sold at the original purchase price?
Mm-hmm.
So that would debit then your cost of goods sold and you would credit your inventory.
Correct. So if you guys remember from periodic inventory, right? When we did our conversion entry, we calculated how much we sold. In this case, I'm going at a per sale basis. I'm recognizing that I sold 10 items. And what it originally cost me was $5.85, right? And I'm going to update my inventory, so I'm going to take it directly out of my inventory. So if I have a total of 100 toys right now available in my inventory worksheet, and I sold 10, this journal right here is going to tell me I need to take out 10 items from my inventory. So then I have a running balance of now 90 toys left, right? So in this case, this is exactly what I'm doing. So periodic, right? We do it at the end, right? We figure out our numbers, we calculate them, we solve for our cost of goods sold. In this case, I'm doing it as I record my sales. So that way I know exactly how many items I sold, and I know how much exactly I'm taking out of my inventory, because I'm going to update my inventory by taking it out. Okay? So again, because I originally purchased it for $5.85, $5.85 times 10, which is the amount of items I sold, gives me $5.85. Okay? So that is going to be the difference between periodic and perpetual. Periodic, we only care about just the sales, and we wait to the very end to find out how many items we sold. Perpetual, we do it as we go. We calculate everything and take it out of inventory the minute we sell it. So this is the best way to keep track of your inventory, because not only are you keeping track of how many purchases you've made, you're also keeping track, a very close track, of how many items you sold at the same time. So this way, at the end of every single day or at the end of every single sale, you should have a running balance in your inventory worksheet to let you know how many items you have in your inventory at all times. So in this case, that's exactly what this is for. Okay? So that's the difference between journalizing periodic and journalizing perpetual sales. Periodic, you only deal with one journal. Perpetual, you have two. You have one to record the sales and one to calculate the cost of goods sold. Okay? Any questions? All right. So, of course, when we're dealing with our perpetual sales, right, we have to consider what happens if our customers decide to return and or want an allowance. So once again, reasons why customers want to return their product. One, simple, is they're unsatisfied. It's broken, defective for whatever reasons, and you grant them whatever your company policy stands for. Okay, so once again, you want to make sure that your sales are finite, that they're sold and they stay sold. So you need to create some kind of company policy to refrain your customers from making unlimited returns for you and keep your items sold. Okay, so whatever policy you come up with, whether it's a final sale, return within 15 days, return within 7 days, etc., right? And with that being set in motion, we need to remember if a customer decides to return an item that they purchased from us, we need to give them back their sales tax. All right, so let's take our first example here. Once again, we have on May 1st, okay, we sold 50 coffee mugs for $5 each, okay? And the coffee mugs originally cost you $1.25 each. Sales tax, once again, is 8.8%, 8.25%. And customer A decides to pay you with cash for these mugs. Record this transaction. So, first things first is, let's look at the transaction at hand. We sold 50 mugs. So let's record that first.
Inventory?
No. We're recognizing, no.
It would be cash.
It'd be cash, right? We're just recognizing the sale first.
Oh, the sale, yeah.
Yeah. Okay, so we're just recognizing the sale first. So what happened?
The 50 times $5 would be $2.50.
Good.
And then let's see.
$20.63 for.
62.3, yes. Good.
Sorry, I rounded. I'm trying to round up.
Good. So therefore,
20.63 on top of that, so it should be 270.63.
correct. That is just that's just the transaction that happened at hand. We sold something to a customer. Now, we need to consider the second part because we're dealing with perpetual inventory. We sold some material. So, if it originally cost me $1.25 each cup, how much is going to be my cost of goods sold?
$62.50.
Okay, so we're going to recognize cost of goods sold, and we're taking it directly out of my coffee mugs, right? For the total of your $62.50. Excellent. Okay. Now, what happens when my customer A decides to return the product? Okay, so May 10, all right? They decide to return 10 of those coffee mugs for a full refund, okay? And your company policy says that you can give a full refund if they return the product within 15 days, okay? So the coffee mugs cost you, once again, $1.25 each. So how are we going to record this transaction? So first things first, right? We're going to recognize, good. We're going to recognize what happened here. The customer returned the product. So let's recognize that first. So what accounts are we going to be dealing with? Okay, so what are we going to be recognizing first? If the main transaction here is a customer decides to return something. So we got cash is going to be refunded, which is correct. What else is going to be? Sales returns, good. And what else?
Self-tax payable.
Correct. We got to give back their sales tax. So here we recognize we're going to refund them something, okay? We're going to refund them for their mugs. We're going to refund them for their sales tax, and we're just going to give them their cash back. So in this case, if I had 10 coffee mugs, right? If I sold them for $5 each, right? How much am I going to refund my customer?
They're at $5 each?
Mm-hmm. Remember, I sold them for $5, right? Let's go back to our previous example. How much did we sell them for?
$5 for 10 mugs. The 50 mugs that they're returning?
So we sold them originally 50 coffee mugs for $5 each. In this case, if the customer's returning, how much did I originally sell it to them for?
54.13.
That's the total,
Oh,
right? Because you also included the
you
tax.
sold them for 50. You sold them for 50.
$50, and the tax is gonna be $4.13.
Correct. Because in this case, each mug that I sold was $5 each. Okay? The customer A decides to return 10 of them. So 10 times 5 gives you $50. You multiply the tax on that to give you $4.13. So the amount of cash I'm giving back to them is going to be $54.13. Okay? Now you have to think really hard and really carefully. The person decided to refund and return the coffee mugs. So what do I need to do? If I'm receiving the inventory back, what do I need to do?
Take your 10 coffee mugs times the original cost of 125,
Mm-hmm.
and so you would debit your coffee mugs, and then you would have to credit your cost of goods.
Correct. You're going to shove it right back into inventory. Okay? Obviously, in real life, that's not going to really happen, right? You're going to have a separate account because they've been touched, used, whatever. But I've seen before a lot of companies, they don't care. They just put it right back on the shelf. Okay?
Amazon.
Sure. But yes. Okay, so what we're going to do is we're going to recredit back our inventory because we essentially got the items back. We need to stock up our shelves right back up. And we're going to take away from our cost of goods sold because we never sold them, right? In another sense, we gained them back. So therefore, we got to revoke that cost of goods sold because it was never sold. We got it back. So in this case, that's correct. We're going to recognize it as $1.25 each, multiply the 10 cups that we actually got refunded for to give us a grand total of $12.50 back into inventory and taken away from our actual amount that we sold. Okay? So good. Is everyone okay with this now?
Sounds good.
Okay? All right?
I'm not, but I'll wait till the next question to try to process it.
Okay. Well, I mean, the next question isn't the same question. It's going to be a different question, okay? All right. So don't worry. We will do the exercises afterwards. You have questions, then you can ask me on Wednesday. All right. So once again, now May 18th rolls around. Customer A wants to return 10 more coffee mugs for a full refund. However, the customer doesn't like the color. Okay, but you tell them that they missed the discount, or they missed the return policy. But they're starting to, cause trouble, cause a scene, and they're angry, and you want to keep your customer satisfied. So you decided to offer them a 15% discount just to keep them happy. Okay, so how are we going to record this discount? Or record this transaction. Let's recognize first thing, what happened here first. They're trying to return an item, but we said no. Instead, we gave them an allowance. So what are we going to recognize first?
You recognize sales returns and allowances first.
Correct.
You'd also have to recognize sales tax payable.
Good. Okay, and we got to give them their cash back. So here, if each coffee mug that we originally sold was for $5 each, right? How much is my 15% discount going to be? How much am I going to refund them for? $7.50. What's my tax on top of that?
62 cents.
62 cents. So there you go. So in grand total, I'm going to give them a whopping $8.12 back just to keep them happy. Okay. Now, question number 2 is, do we need to update our inventory?
but your inventory didn't change.
Correct. So therefore, no need to calculate the cost of goods sold because they kept the items. You didn't put it back into your inventory. So therefore, it's sold, it's gone. You're only recognizing the discount off of the selling price. Okay? Any questions there? So for allowances, since the initial idea is that you're allowing the customer to keep the product, you don't need to shove it back into inventory because the discount isn't based off of the item that you sold. It's based off of what the price that you sold it for, and you never received it back. So in this case, you're not going to update your inventory at all. All right. Last but not least, we have to recognize our sales discounts. Okay? So, of course, sales discounts, right, as we all know, entices our customers to want to come and shop at our store, right? No one wants to pay full price for a product unless they absolutely need it or want it, okay? Most cases, everyone would come in just because there's some kind of promotional sale, some kind of grand opening, some kind of store-wide weekly ad sales on certain products. I don't know. Any reason that you can come up with some kind of sale. But another thing too is, that's one way to get people to actually buy your product, right? Is to have a sale. So we're going to be looking at two types of sales, right? One for a regular store-wide sale and one for giving to customers. So once again, let's take a look at this in-store sale, okay? On June 1st, okay, your store is having a promotion on all items are 40% off, okay? And a customer decides to buy 10 baseball hats, okay, with cash, okay, which original selling price is $10 each, okay? And if sales tax is 8.25%, if the hats originally cost you $2.50 to purchase, right? How are we going to record this transaction? So first things first, let's recognize the sales, and then we'll calculate our cost of goods sold. So what happened here?
We had a cash sale, so you would have to recognize cash. And
Good.
You also had a discount, so you would do a sales discount.
Good.
Then your credits would be sales and sales tax payable.
Correct. So let's go ahead and calculate all this. We sold 10 baseball hats at $10 each.
It'll be $60 cash. Oh no, it'll be $100 cash. The sales discount is 40. Now I'm lost. Hold on.
Okay. Your numbers are correct, but not in the right accounts. So let's first recognize one thing at a time. What was your sales, just in general? When we're calculating our sales, right, we have to keep it at original price. So what was my sales total that I sold at the original price?
The original price was $100.
$100, okay? What was my discount percentage?
40%.
40%, so my discount is $40.
Yes.
How much tax can I charge?
$4.
$4.95.
$4.95. How did you get that number?
60 times 8 to 5%.
Good. So therefore, my grand total is that I should be receiving in cash should be $64.95. So here we recognize that we have a sales of 100, but we're not receiving the full 100. We're only receiving $60. And we can only charge tax on based of what we actually sold. So in this case, tax is going to be calculated based off the $60 to get you $4.95. So the actual cash you're going to be receiving is $64.95, okay? Now, if I sold 10 baseball hats, how much is my cost of goods sold?
$25.
Right? So good. So if it cost me $2.50 per hat and I sold 10 of them, it's going to be for $25. And I'm going to take it directly out of my inventory. Okay? Excellent. All right. So now here is sales when we're dealing with a customer or a client. So once again, July 15, a customer wants to buy in bulk. They decided to purchase 100 baseball hats from your store on an account, okay? And because they bought in bulk, you offered them a discount, right? Or terms of 5% if they pay the whole thing in 15 days. If not, then the whole bill is due in 30. Okay? And each hat you sold was for $10 each with the sales tax of 8.25%. And there was a delivery charge because you didn't have all 100 hats. You decided to offer them shipping, okay, for $10. And then, last but not least, a little piece of information that you need to know. Each hat originally cost you $2.50 each. Okay, so let's record the sales first.
Sales would be $1,000.
Sales would be $1,000, right? Let's recognize my accounts right now. So what am I going to be?
Accounts payable.
No.
Oh,
Accounts receivables.
Good.
accounts receivable, yes.
Right. We're dealing with a customer. Good. Accounts receivable. What else?
Well, you have sales,
Mm-hmm.
and you have sales tax,
Mm-hmm.
and you also have a delivery charge.
Correct. So we're going to recognize that this customer is owing us the money. Okay? We recognize that we sold our items at $10 each, which is $1,000. Okay? And what was the tax off of that $1,000 that we sold?
It should be
$82.50 plus we also have to charge $10 for the delivery charge to give us a total of $10.92.50, right? Because we're giving terms. When do we do the discount?
When they pay.
Exactly. So this transaction is now complete. Now, because we sold something, right, we can account for taking away that 100 hats. We don't have it anymore. So therefore, what is my total cost of goods sold?
250.
250, right? Because we got rid of 100 hats, which originally cost me $2.50 each, to give me a total of $250. Okay? So then, fast forward, let's say on July 12th, the customer decides to pay and they met the discount period. So, what are we going to do here? Okay, if they received a 5% discount because they paid within the 15 days, how are we going to record this transaction?
Accounts receivable.
Do we debit or credit?
We're going to be crediting.
Yes, good, excellent. What are we going to be receiving? Typically, cash or a check, right? Depending on how, like, what kind of method if they came into the store and they paid us, then you're going to receive cash. But most cases, usually it's either check or online. So it's either cash or checking. Okay. We're giving him a discount. So what else do we need to recognize?
The sales discount,
We need to recognize the sales discount. What else do we need to recognize?
sales tax payable.
We need to give back their money. So excellent. Cash, sales returns, or sales discount, sales discount because he made the discount period. And we have to give a portion of his money back because we already calculated the tax. We got to give it back. Okay? So in this case, how much was my total sales originally?
Total sales with the shipping as well
No,
was okay.
just my total sales. What did I originally sell the items for?
1,000.
1,000. So what am I gonna take the discount off of?
The 1,000, so
Good.
$50.
$50, okay? And what's the tax off of that $50?
$4.13.
Good. And how much does this customer owe me in grand total?
1,092.50.
Correct. So therefore, how much money am I going to be actually receiving? Okay, I should be getting 1038.37, right? Because they owe me 1092. But because they made the discount period, I need to recalculate what they get, right? Because they deserve it. They paid me on time. I have to calculate how much my discount was for. I have to calculate the tax to refund because I already charged them the tax for it. And therefore, I should be getting less money back, right? Because they got a discount. Okay. Now, question to you. Do I need to update my inventory?
No.
No, nothing happened. You sold the items, they're gone. The discount does not affect the inventory at all because this discount is based off of the selling price, not the purchase price. So in this case, that's it. So here's a little fun fact that you need to know. The only thing when you're dealing with either a returns, allowances, or discounts, returns, if they return the product to you for a refund and they actually gave you back the product, you put it back into inventory. Okay? If you allowed to keep that, let them keep the items and you gave them an allowance, you don't need to update your inventory. Same thing here. Any discount does not affect inventory. Okay? Chapter review, once again, we took a look at what we do when we have sales, right? We recognize we need to record the first things first. What happened? We sold the item. Second thing we have to recognize is calculating how much it cost us to sell those items. Okay? So there it is. Okay? A little tip here, like all costs go straight into inventory, like we've mentioned before, right? You can't take a discount off of your tax and etc. Okay, lost my train of thought. Sorry about that. So here you go. We've got to take a look at what happens when a customer decides to return a product to us. If they actually return the product to us, we need to recognize we got to put the item back into inventory. Okay? But if we gave them an allowance or a discount, that doesn't affect inventory because we don't need to put the inventory items back into it. Okay? It's gone. Nothing happened there. Right? Same thing with the discounts. We got to take a look at what happens when there's a store-wide discount versus giving a personal discount to our individual customers based on terms. Okay? All right. Any questions in regards to this? Okay. Let's go ahead and go over this example right here. Okay? So here is 7.4, 7.5, 7.6 perpetual inventory sales exercise. So, question number 1 says we're going to journalize and we're going to assume that the sales tax is 8.25%. Okay? And you purchase a total of 500 cups with a total cost equaling up to your cost is going to be $1.36 each. Okay, so that includes all the freight and expenses. So your cost per item is $1.36. Okay, so let's take a look here. On April 5th, you decided that you sold 100 cups at $5 each to customer A for cash. So what are we going to recognize here?
You're gonna recognize cash first,
Mm-hmm.
and then sales tax payable.
Okay.
Sales tax receivable because you're receiving it from the customer.
Okay, no. Remember, payable means that we owe the government. Yes, it's true that we are receiving from the customer, but that doesn't increase ourselves, right? It's not an
Right.
asset to us.
Yeah, it should be credit sales and then credit the sales tax.
Good. Good. All right. So, if I sold a total of 100 cups at $5 each to customer A, what was my total sales? $500, right? 5 times 100. 5 times 100, 500. So how much is going to be my tax?
41.25.
Yes. Okay. So therefore, what's my total cash I should be receiving from customer A? 541.25. And I'm going to go ahead and make a note that I sold I sold how many? 100 cups to customer A. Okay? I don't need to write for cash because it's clear that I received cash. Okay? All right. Now I've recognized that I made a sale. So what is the next thing I need to recognize?
Your inventory change.
The inventory change, because I wrote up here, right? I purchased originally 500 items. If I sold 100 items, how much do I need to take away from my inventory? 100 items. So if each item costs me $1.36 each, what is my total cost of goods sold?
$36.
Okay, cost of goods sold. I'm taking it directly from my inventory, which in this case, what is my inventory item? Cups. So make sure that you're specific, right? Because we're dealing with inventory. Cups. All right. So what was that amount again, Alan?
136.
136. Yes, even, right? 100 times $1.36 gives you 136. So once again, because this is the same transaction, you can leave the date, but in this case, I'm going to make sure I recognize it. Okay? And I'm also going to reiterate this once again. Sold to customer A, right? Because what if customer A decides to return? If they decide to return, right, that means we need to make this association that we decreased the amount of items that we sold to customer A. Okay? Boom. All right. Now, there are other ways around it too. If you want to keep the transaction very together, you could do the description for the second transaction and not the first transaction, but that's okay. I just want to be consistent. Okay, so you guys know exactly where they're coming from. All right? Good. All right. So then what has happened next on April 7th?
You sold 25 cups at $5 each to customer B on account with funds.
Yes. Ooh, so yeah, I keep forgetting to update this one. This one happens every year. All right, so you sold 25 cups at $5 each to customer B on an account. And what did you give customer B?
In terms of 10% within 15 days or net 30.
Mm-hmm. Good. So what am I going to recognize here?
Accounts receivable.
Accounts receivable. Good. So 4-7. Accounts receivable. Okay. What else are we going to recognize?
Sales tax.
Mm-hmm. What else?
Well, sales.
Mm-hmm. Okay. So let's take a look. How many did I sell? I sold 25 at $5 each. So what is my total sales?
$125. Tax is $10.31.
Hold on. $10.31?
Yes.
Okay.
So 31.35 and 31 cents.
135.31. Okay. Good. And last but not least, I'm going to make a note here that I sold to customer B, or what did I say? I sold 25 cups to customer B, comma, I'm going to give them a 10% discount if they pay within 15 days. If not, they owe me in full in 30. Okay. All right, I'm going to give a couple seconds to catch up. Okay. Okay. So then, what happened next on April 10?
So we wouldn't have to put that into the cost of goods?
Good. Okay. So if I sold 25 cups, right? How much did it cost me?
Times the 136?
Correct. So in this case, cost of goods sold. How much did it cost me to sell 25 cups?
$34?
$34. Okay, hold on. Inventory. Nope. This is cups. Okay. So once again, this happened on April 7th. So we sold 25 cups for $1.36. So what was that again, Nicole?
$34?
$34 even? Good. All right, and then I'm going to make a note here. Sold to customer B. Okay. Okay. All right, so then what happened on April 10?
Had another sale, cash. And then So we had customer C that bought 50 cups at $5 a piece.
Mm-hmm.
So we sold it for, of course, $50, $250.
Okay.
Sales tax was $20.63.
Hold on. So we got cash, we got to recognize sales, and we have to recognize sales tax payable. Okay. So what was the sales again? Total? So if it was 250, right? Because we sold 50 cups at $5 each, so it gives you 250. The tax was for
2063. I rounded up. It was and
good.
then, $270.63.
Good. Once again,
Cost of goods sold.
hold on, sold to customer C. All right, and then okay, so now we're gonna recognize what we have to take away from our inventory. So in this case, cost of goods sold
And cups.
in cups. Good.
You know, I could see with the notes. I totally forgot how many we sold already.
We sold 50.
25. 25. So 25.
No. We sold 50. Right? We sold 50. Customer C, we sold 50 cups to customer C. So, okay, my bad. That was probably supposed to be in the description. So I was supposed to sold 50 cups to customer C. All right. So we sold 50 cups at $1.36.
$68. Cost of sold and cups $68.
Okay. Once again, sold to customer C. Okay. Good. I'm going to give a second real quick. Okay. Okay. So then on April 15, what happened here?
Customer A returns 10 cups for a full refund.
Customer A decides to return 10 cups for a full refund. Okay? In this case, we're going to grant him the full refund. So, April 15, or was it April 12th? Yeah, April 15. So, how much is the refund for? What are we going to recognize?
Sales returns and allowances.
Mm-hmm. We need to give them back the refund. Okay? What else do we need to recognize?
Sales tax.
We need to recognize sales tax. Right? Give them back their money. And lastly, how did customer A pay us?
Cash.
So therefore, we're going to typically give them back their money in cash. So let's go ahead and calculate it. Okay? If we originally sold the cups, right? If we sold each cup for $5 each, and customer A decides to return 10 of them, how much is their sales returns and allowances?
$50.
Okay. How much tax is going to be refunded?
$4.13.
Therefore, we're going to be giving them back a whopping $54.13. Okay. And I'm also going to make a note here that customer A returns 10 cups for full refund. Okay. So then, what happens next?
Customer C returns 25 cups, but is willing to accept it for 2.
Okay, before we think about that, what did customer A do to us?
For a full refund?
They got a full refund, but what else did they give back to us?
Inventory, cups.
They gave us back our cups. So therefore, what do we need to do with that? We need to shove it right back into inventory. So we need to recognize it because we actually received the inventory items back. So in this case, we need to what?
Cost of return.
Mm-hmm.
You would start with cups.
Mm-hmm. Because they gave us the cups back.
Yes.
Okay? And you're right, Felipe. We need to recognize that because they gave us back the cups, we also need to revoke that we sold those cups. All right? So, if it costs us $1.36 each cup, how much is 10 cups refunded for? $13.60. All right? That's how much is going to go back into my inventory. Right? And of course, you can make a note that customer A returned, but this is just fine because you already know what you're doing, right? You didn't gain inventory. You didn't make a purchase inventory. This is pretty clear, right? If you could just make the association. Okay. So then, now, what has happened on April 20th?
Customers.
So what did customer C do?
Return 25 cups, but is willing to accept a 50% discount.
Okay. So, customer C, all right, wants to return, but is willing to accept a, was it 20% discount? So, oh no, 15% discount, my bad. 15% discount. So, what am I going to be recognizing here? I think I've been writing the dates wrong.
Still do sales returns and allowances.
Correct, because we're not getting a return, or we're not giving a return, we're giving it an allowance. So in this case, sales returns and allowances, okay? What else are we going to have to refund?
The sales tax.
We have to refund the sales tax, okay? And lastly, how did customer C pay us?
Cash.
They gave us cash, so therefore we're going to give them back their cash, okay? So let's take a look. If they're trying to return 25 of the mugs, right? Because they bought 50 originally. How much is it gonna cost me to give them a refund back or for the 15% discount?
$18.75.
All right, how did you calculate that?
I did 25 times 5
Mm-hmm.
times
Okay.
percent, and I ended up with 18.75.
1875. So 25 times 5 times 15 should give you 1875. How much tax is going to be on the 1875?
$1.55.
$1.55. So in grand total, how much am I going to be giving this customer their money? How much money am I giving them back? I mean,
$20.30.
$20.30. Good. Okay, now I gotta make sure I write this. return, no, customer C, I guess I'm going to put allowance, 25 cups for 15% discount. Right? Good. Do we need to update our inventory? No, because we told the customer to keep the inventory items, and we just gave them a portion of their sales money back. Okay, we did not receive the inventory, so that is done. Okay, so last but not least, what has happened on April 22nd?
Customer B is gonna end up with a 10% discount on his price.
Good, excellent. So let's take a look at customer B. We sold them 25 cups at $5 each to customer B. So let's take a look at that transaction on April 7. Here we are. So how much in total did they owe us?
135.31.
Okay. How much was the actual price that we sold them to?
125.
125. So let's go ahead and recognize what we need to recognize. They're paying off for what they owe us. Okay, so therefore, what are we going to recognize?
Accounts receivable.
Accounts receivable, right? Now, are we going to debit that or are we going to credit that?
This time we're gonna be crediting it.
Good. All right, so then that's going to be the last thing that we recognize. What should we be recognizing?
So it's gonna be sales and sales tax.
No.
Oh no, because it's account receivable.
Yes, we already recorded the sales already. If they're paying off what they owe us, what should we be receiving from them?
Cash or check?
Yes, because they're paying off what they owe us. So therefore, we should be receiving some form of money. Okay? Because they met the 10% discount, what else do we need to recognize?
Discounts and allowances.
There's no discounts, allowances. It's just discounts.
Okay.
They're not returning anything. They're receiving a discount from us. Good. If they're receiving a discount from us, what else do we need to recognize as well?
Sales tax payable.
We need to give them back the money that we originally charged them for sales tax. All right? And then lastly, we're going to recognize the total amount that they owe us. Okay? Which in this case, how much was the total amount that they owe us for?
$100, 135.70. Sorry, 135.37 cents.
135.
And 37 cents. Am I correct or 131?
31. Good. So that's how much they owe us. 135.31. Okay. Now, we took a look at how much the sales was for, right? The sales was originally for $125. So, how much is my discount going to be off? Going to be on
The 125.
the 125. So, what's 10% of 125?
$12.50.
$12.50. Okay, no, so here. $12.50. How much tax do I have to refund?
$1.03.
Okay. So therefore, how much cash am I supposed to be receiving?
$121.78.
Okay, 78.
Am I correct on that? Because we take the amount and then minus the discount and minus the taxes, correct?
Yes, right. Yeah. 78. Good. Sorry, I was trying to add them all up together. So good. 121.78 is what we're going to be receiving. And just to end off our little description here, customer be paid in full and received 10% discount. All right. And that concludes our exercise. Any questions? Okay, perfect. We end exactly at 5 o'clock, so no extra overtime. Once again, if you have any questions in regards to this, just wait till Wednesday and you can ask me.